Recording in progress.
Good morning and welcome to our today's webinar about materiality and ESG strategy. My name is Michael Kaufenberg. I'm the director of Deveco. We are a consultancy in ESG topics and everything about decarbonization. And I am joined today by Manon Canty.
Good morning.
A senior consultant of Deveco. Deveco is part of Athos Group, one of the leading tax advisors in Luxembourg and financial services. And so today we will talk about the double materiality assessment, which is the basis of every ESG or successful ESG strategy and approach. We will start at the beginning with the definition because it's something that is not so old in the market, and we talk about what are the steps to do the assessment of double materiality, and then coming to I think the most important part, which Manon will take over, about building the value creation strategy out of a DMA. So let's start right away about the definition what a double materiality is. So it is called double materiality because in the first place you have to assess and analyze all the impacts that your activities throughout the whole value chain of your company is provoking on the planet, on society. That's why we take a look from inside out. It is called double materiality because, on the other hand, we also see we have to analyze what are the financial risks and the opportunities coming from these topics from the outside in on the company. So that's why we're talking about an impact materiality and the financial materiality. In the past, materiality was rather seen only from the inside out, from the impact side, and the risks were mainly assessed on the impact that you have. For instance, I have an impact on pollution, and what are the risks that I financially can have out of this impact that I'm provoking. Now, on the new double materiality assessment concept, the financial and the impact materiality are analyzed in a separate way. So you can imagine that you can have a financial materiality on topics that you don't really impact. Let's say if you take, for instance, the food industry, of course, in the production process, they need energy and they have an impact on climate. But independently, for instance, if they are dependent on ingredients coming from regions that are really suffering from droughts due to the climate change, this can be a financial impact regardless the impact that they have. But you can also see it on a positive way. You can imagine companies that have products or services that really meet a need on a broad scale of a topic like pharma industry on health or like tech companies on security, which really can lead to new financial opportunities due to a topic that they do not in the first place impact on their activities. So it is really to see both aspects separately, and a topic becomes material if it's or material on the impact side or material on the financial side. And of course, if both are material, it is of course material too. So you see the double materiality in a lot of ESG regulation and frameworks. It became most popular due to the CSRD, the new directive on sustainable reporting, which has been delayed now due to the omnibus package, but it will still happen and it's coming very fast, which really defined the double materiality, and it is mandatory to do this assessment if you have to report under the CSRD. And they even provided a methodology how to do it, and which we will come to it later. If you take the SFDR, the Sustainable Finance Disclosure Regulation, You see on the one side that you have to disclose on sustainable risks and on the principal adverse impacts, which are echoing also the double materiality logic from the inside out, from the principal impact, but also from the outside in on the financial risks that are linked to topics. Under the EU taxonomy, you see that the concept of prioritizing impact materiality by defining what counts as sustainable activity when you are aligned on a topic according to that methodology. On an international level, you see that the IFRS with their framework S1 and S2 issued by the ISSB also focus on financial materiality, not so much on the impact, but more on the financial materiality, thus meeting the needs and the expectations of the investors. So if it is now a lot integrated in regulation and framework, this is coming out of all the analyses and surveys on an academic level that really showed that you need to do this assessment to identify the topics where you have to disclose on it. But as we will see, it's not only a matter of compliance, but it is a matter of using them to create values. So coming to some points, what a DMA is not. So it is not just a stakeholder survey that you ask your stakeholder, what do you think is important regarding our activities? It goes further. It is really a quantitative risk, impact, and opportunity analysis to be able to fulfill this strategic prioritization. It is not, of course, only a list of ESG topics that you have to run through. It is really going more in detail and analyzing each topic on the value chain. And of course, the DMA is not a one-shot or one-time exercise. Things can change. We'll see that later. And the context in which a company is evolving can change. And thus, the DMA has to be revised from time to time to see if everything has remained the same and is still material, or if some changes need to reassess the materiality and come to new outcomes. Then it is not an unstructured and undocumented process. It really needs to have a clear methodology, to have a proper documentation, and to really explain the justifications why something is material or not. And then, of course, as I said before, it is not limited on or the impact only or the financial materiality only. It has to be taken in consideration, both of them. And of course, coming to the compliance, it's not just another compliance exercise. It is requested, especially in the CSRD and also in other framework, but it goes beyond. It's above all a strategic management tool to unlock value and to drive long-term profitability. So, and as the famous Jean-Marc Jancovici, the father of the bilan carbone in France, said that it's really not about the compliance checklist, but it is about to ask the right questions. What is really important, and as the French says, pertinent for your activities. And it's not about, as in the past, having an actionism about replacing plastic cups by glasses, which is still a nice move to do, but it is maybe not really crucial regarding the core activities of your business. So what are the main steps of producing a double maturity assessment? Before coming to the concrete steps, it is really very important to have in mind that it needs a solid quantitative foundation, okay? Because this is really needed to create the value. Otherwise, we remain in the more marketing approach of analyzing it. And thus, it needs to integrate a quantitative layer so that it is possible to compare and to benchmark even, and really provide the actionable insights to be able to take the right decision. And of course, that's the experience that we always see when we run such an assessment with a customer. It really gives you a different view on your activities, on your operations, on your processes, and it really gives you also the important possibility to shape that operation, invest, and also, of course, the engagement with your stakeholders. So when we come to the steps to do a DMA and to identify the material ESG topics, there are two major steps to take into consideration. The first one is to do the mapping of the impacts inside out, outside in on all the ESG topics. And the first step to do that is to first assess your full value chain, not only the core activities that you do to produce your product or your service, but all the upstream activities coming from procurement, logistics, research and development, but also all the downstream activities related to your products, like waste management, end of life of products, and customer care, and so on. And of course, throughout the whole value chain, all the support activities like HR management or IT and infrastructure management too. Then on each segment of your value on each activity on the value chain, you need to identify the topics that are related to these topics, the risks, the impacts, and the opportunities. And then, of course, it is very important not only to do this from an inside-out view, of maybe only the sustainability team who is in charge, but you have to engage the key internal and external stakeholders. And when I say key internal and external stakeholders, this needs also a kind of analysis and a categorization of your stakeholders. They are not every stakeholder has the same importance, and you have to analyze them in a way that which are the most impacted by your activities and those who are the most influential on your activities. For instance, in some sectors, NGOs and media are maybe not impacted by your activities, but they really can harm you if they take a topic and try to give a negative opinion on this. So you need also to double check what you think is material by internal and external stakeholders to have this view and to include it in your assessment. Having done this mapping, then comes the real important assessment of the materiality, and this needs to conduct a methodological evaluation which enables you to do the comparative scaling. If you take the impact materiality, CSRD and the institutes behind the EFRAG, they recommended a multi-criteria evaluation on severity, scale, and irreversibility of the impact that you produce or may produce. Then it's not only the impacts that are happening every day or that occur to happen, but it's also about the potential impacts that you can have, and that's why they also include the likelihood to evaluate. Okay, for instance, I never had an incident on this topic, but sometimes under some circumstances there could be a likelihood that it happens, and then I am able to calculate with this likelihood what is the materiality. On the financial materiality side, they have also the criteria on the risk and on the opportunities to see what can be some kind of financial magnitude linked to this topic. And then again, also about the likelihood. If you see, I have an opportunity on this topic that I can create a product or a service, what is the likelihood that it could be sold and that I can find customership or not? And on the inverse side, on the negative side, if there is some financial risk, I mean, is it really likely that it will happen, or is it more rare that it can happen. So it can diminish in the quantitative evaluation. And of course, it is very nice to visualize the results. We give you two examples, one coming from Post Luxembourg and one from BNP Paribas. The first one is called matrix, where they took on one side the financial materiality and on the other side the impact materiality, and you see everything which is a major or moderate will be taken in consideration for the strategy and to disclosure on it, and everything which is low and not important. I mean, they didn't, because there were such a lot of topics that they did not introduce it in the graphic, will not be taken into account. The one of BNP Paribas is my special favorite, because they really see it on a more three-dimensional way. As the post view of financial materiality, it includes the risk and it combines rather the financial risk and opportunity on one axis, and the BNP Paribas, they treat them separately. So they see they have the scale of from not important to very important or even crucial, with some graphic coloration, and they see everything that is colored in light to dark green on the impact, but also on the risk, and separately on the opportunity. When they have one of these, which is important, it is a material, and you see that all those that are only gray and have no green inside, they are listed on the right side, are taken as non-material, which is a quite a nice way to visualize your materiality. At the beginning, I said that a DMA is not something static, but it's dynamic. And you see in the example of Philips that they had assessed their double materiality in 2022 with which high double materiality on fair and inclusive workplace and big data and privacy. And in 23, they reassessed, and suddenly they see that the product responsibility and safety is becoming material on both criteria, which was not the case before. And so you see that you can even, I mean, maybe not each year, but if circumstances externally or internally change, you need to redo your assessment, because the results could differ from one assessment to another, and thus update your data and update also your strategy. So especially for private equity firms, there are some challenges because they may have diverse portfolios. So in a portfolio, there can be companies from different sectors. So it is difficult to have to apply a one-size-fits-all double materiality assessment. It really needs more a tailored approach, and to do the assessment on every sector and every entity in terms of evaluating the impacts on their proper value chains, and then compile and consolidate all the different material topics to an overall double materiality on the portfolio. It really needs the engagement of the management of the private equity. We see in several analyses and surveys, the latest one was from the SSF from November, that they see that there is a lot of compliance on the SFDR and on the private equity company level, but that there is a lack of going deep in the portfolio, because that's where the economic reality happens. And the management of the equity firm have a direct influence. I mean, if they're on the board, they can really lead and improve, like for instance, environmental practices regarding decarbonization. And indirectly, they may be also impacted by the risks. I mean, if you have a company where you have little operational control, but that they have, for instance, a deeper human right violation problem, it can impact also the private equity. And then what we see, why? I mean, this is not a lack of willing. It's often due to the scarcity of information. Often there is a limited data availability, especially regarding on the value chain, and the lack of transparency across complex value chains where you simply don't have access. But this is really one of the challenges. If you want to create value in your portfolio, you need to deep dive in the companies to have this insight. So common assumption and missteps on what can happen during the DMA is, what we see is that it is taken too easy, that it is the process is started too late or in a rush, and without a clear defined methodology and a framework how to approach it. And it is often underestimated that the scope and the complexity of the workload can be quite important. So, I mean, if, for instance, for the CSRD, if we have 2 more years to do it, just profit because you need the time to do it properly to come to a result. Often the relevant stakeholders are not engaged, so it is really important not only to see it from an internal point of view, but you need also to include external or so-called silent stakeholders like NGOs or like next generations to see how you can assess their opinions to include in your own reflections. Then the whole process needs documentation and a thorough communication internally and externally throughout the process to be successful. And of course, it is not only the charge of the sustainability department, it needs also the commitment of the board of directors. They have to participate actively in the process of the DMA. Okay, so this is about what is about the definition and the process, and I now leave to Manon to explain you how to use it and really to create a value creating strategy.
Yeah, thank you, Mike. Yeah, so now we have explored the fundamentals and the execution of the DMA. Let's move into the next critical phase, which is using the analysis to build a strategy that not only ensures compliance, but truly ensures great value. So once your DMA is done, is validated, the first step is to develop an ESG strategy. So this strategy has to be deeply rooted in the material issues identified, so with KPIs that are not just measurable, but also very clear and time-bound limited. So also ensure transparent communication of the targets to stakeholders, very important. Then the second step is the execution. So you have to translate the strategic ESG priorities into actionable and cross-functional initiatives. So this means integrating your ESG strategy, ESG priorities across departments, all departments. So operations, supply chains, management, corporate governance, and very, very important organizational culture to drive meaningful impact. Everyone must be involved in the action plans. And then the achievement of financial and non-financial value. So you might see a cost reduction through operational efficiency, risk management, and also enhanced access to sustainable finance. But you might also see non-direct financial gains like stronger employee engagement, customer loyalty, and also long-term stakeholder trust that we talked about previously. So we'll now give some example of research that shows that ESG is good for business. So just some example of studies you can find online. So according to Oxford University and Arabex partners, 88% of companies with strong sustainability practice saw better performance, operational performance, and superior stock performance for 80% of them. Another example is GRI data that shows over 75% of executives believe non-financial factors are critical for long-term success. Another example, IKEA, which has seen a 25% jump in customer loyalty from its ESG initiatives. And you have a very, very famous example, BlackRock, with his famous as well CEO, Larry Fink, who said incorporating ESG considerations into investment decision is no longer an option, it's a necessity. So when you conduct a DMA, a double materiality assessment, you are not just thinking a regulatory box, you are setting the foundation for authentic, measurable, and strategic growth. Now let me share a more concrete example, which is Unilever. We choose this one because it's quite famous too. It's so Unilever launched in 2010 as a sustainable living plan, and we all agree in the ESG sector that it was visionary. So it decouples business growth from environmental footprint. And so in their DMA, they identify climate risk, resource scarcity, and social inequalities, and they put a lot of action on it. So for instance, sustainable sourcing, eco-packaging, and energy efficiency. And they monitored it through annual impact reports with a lot of KPIs, aligned KPIs. So the results are very clear. Sustainable brands grow 69% faster than the other and accounting for 75% of total company growth. So another very impressive number is that Unilever saved nearly $250 million on energy alone. And you have a lot of other actions who also allowed the mitigation of the supply chain disruption. So what we see is a very powerful example, very powerful lesson. A forward-looking company, forward-looking strategy built on materiality, insight can generate both purpose and profit. For private equity firms, the story is slightly different, but still just as compelling, because here double materiality becomes a strategic level for value creation across an entire portfolio. So first, PE firms can better align with limited partners' expectations, improve transparency, and attract ESG focused capital. And also, very importantly, it helps mitigate risks. So reputational risk, regulatory, and also operational across the different holdings, which are very diverse and complex.
Maybe telling also that each company in the portfolio can have the same results, identical results like Unilever. They say that if you increase the value through ESG strategies on the different companies in the portfolio, your overall value of your portfolio can really be heightened.
Exactly. So we see that in a very rapidly evolving ESG landscape, as we saw in the previous months, those who invest with intentionally will be best positioned to lead. So now let's look at a different example, a different kind, which is an application of how double materiality assessment can guide climate strategy and generate value. So just for your information, this example is taken from a very interesting document developed to help entities to meet the disclosure requirement of EFRS that we talked about previously also. And so in December, because IFRS sustainability disclosure standards are issued by the ESSB, were issued by ESSB in December 2024 to replace the TCFD framework. So this example is an Australian bank in a very climate sensitive area, and they are very reliant on fossil fuel electricity. And so they face physical and transitional risks. So physical, for example, climate risk like extreme weather events that we know all about now, and transition risks, for instance, policy shifts and also changing market demands. So based on the insight of the DMA, the bank developed a strategy with some pillars. So first, renewable energy development fund. So to invest in wind, solar, clean tech, really to reduce dependency on fossil fuels and drive down emissions. Then you have their climate resilience fund. So it upgrades physical assets to resist climate impact and ensure business continuity. Another example, another action is a new technology fund. So to seed innovation in emerging climate solutions, for instance, hydrogen. And then you have the capital allocation for GHG reduction. So the objective is to redirect investments toward projects with measurable emission reductions guided by internal carbon pricing mechanism. So we see that the result is a strategy that doesn't just comply with regulation, it creates value. And you can see through the diverse examples, the diverse actions they put on the table. So by mitigating risk and developing the company's reliance, unlocking opportunities in sustainable finance and driving both environmental and social impacts. So to wrap up this presentation, we wanted to emphasize the benefits of integrating DMI into your ESG strategy. So first, you understood that it enables strategic focus. So by aligning ESG with your core business objectives, you can prioritize actions that have the greatest impact. First, the risk control. You anticipate ESG risks and opportunities, and then you reduce exposure and meet also expectations. And then you build also strongest trust. When you communicate transparently with your stakeholders, you build credibility, you attract also long-term partnerships. It also fosters operational excellence because DMA reveals efficiency gains and cost reduction opportunities. And it also enables product and service differentiations. Companies that proactively adapt, we see that they stand out with distinctive and high value offerings. And finally, to develop investor attraction and alignment, transparency through DMA builds confidence and facilitates long-term capital engagement. So to sum up, forward-thinking companies, we see that they are turning what was once just a regulatory requirement into a competitive edge. And that transformation starts with a robust double materiality assessment. So we have now finished the presentation. Thank you for your attention. And we are now ready to answer your questions if you have any.
So hopefully that you have questions, but nevertheless, we will send you a mail after our webinar that, of course, you can ask a certificate of participation. And if you have questions that come along later, don't hesitate, send us the questions. We will try to answer them all. And you also can ask for our slides from the presentation. And of course, the webinar itself has been is available to see again on video later on. So I just asked the team behind, are there some questions that...
We don't have any questions.
don't have any
Yeah.
questions. So that means everything was clear, or the opposite. And so just feel free to put your questions that we are really willing to answer. No questions? Okay, then thank you very much for attending, and hope to meet you soon for our next webinar, which will take place in September after holiday. And as I said, if you have questions, if you need some further explanations about how to build a strategy and how to implement the strategy later, feel free. We would like to help you. Thank you very much.
Thank you very much. Have a good day.
Bye.